Welcome back to EDS, and in this video we're going to take a look at how we've managed our positions over this last week, and we're going to do a little portfolio update, and hopefully you can pick up a few things about how you can manage your own positions in your own portfolio. So lots to go over. First things first, we're in our brokerage platform. This is our list of positions. We've got 6 positions on the Australian dollar futures, Canadian dollar futures, AMD, GDXJ, SMH, and UAL. Let's just start at the top. So with the Australian dollar futures, we have still got 68 days left on this contract. We're currently in a little bit of a drawdown on the position, but it's not a problem. That's very typical of new strangles. Of course, the market is going to be moving, whether it moves up or down. It is going to have a negative effect on one of your contracts and a positive effect on the other. So with the Australian dollar, there's really nothing to do. It's literally just a case of waiting and just let volatility decay. Contract, and let theta decay away the contract. Next up, we've got the Canadian dollar futures. We've got 40 days left in this contract. Very, very similar story to the Australian dollar futures. The only difference here is the duration on the contract. So with the Canadian dollar, again, we have just put the position on not too long ago. Price has been moving around. We are closer to break even on that. With the two futures positions, we're not worried about that. They are very new and there's nothing to do on those except just wait. So with AMD, this is the first interesting one. This is an iron condor. And if we have a look at the order chain, our original iron condor was at the 130, 135 put on the put side, 185, 190 on the call side. So the put side has always been where it is. However, the call side used to be a lot higher. On the original Iron Condor, we opened it, collected $1.60. Our Iron Condor was up, the call side was up around here. We then rolled the call side down to where it currently is, collected another 40 cents in premium. It's a $5 widespread. In total, we've collected $2. So $3 of total risk on AMD. Right now, we currently are in a little bit of a negative $83 loss. In hindsight, of course, it would have been better to just not make the adjustment, but that's in hindsight. We did open the position around here. Market just went completely against us. So at this point, I mean, in hindsight, we should have done nothing, but at the time there was no way to know that market was going to rebound. So we made the adjustment, collected a premium. As we can see, price is still not breached the long call strike, so there is still a chance of this position coming back. I'm not looking to actually make any money on AMD and SMH, to be fair. If I can make some money on AMD, fine, but with AMD, I'm happy to just get out a scratch or a small profit or a small loss or whatever. With iron condors, you're very limited with how you can manage them. Very limited. It's not like a strangle. We're going to go into some strangles later on in the video and you'll see the difference. With an iron condor, once the two sides basically meet up, there really is nothing you can do beyond that. So with AMD, we're not worried because our loss is limited. This is a limited loss potential position. We're not worried. We defined our risk on entry. It's just a case of seeing what happens. With SMH, we're going to skip GDXJ for now, and we're going to come back to it. But SMH is very, very similar to AMD. It's almost identical. We opened the position, price came down, we rolled the call side down. As you can see, we rolled the call side down. But then what we did with SMH, as you can see, the price then rebounded. Same with AMD, hit our call strike. Well, now, what's not to say that the price is going to keep moving higher. We've all AMD and SMH are very similar positions, so I chose to manage them slightly different. With AMD, we left it as an iron condor. With SMH, we rolled the put side into an iron butterfly or an iron fly. In doing so, we collected more premium. So we collected an extra $1.26 compared to with AMD. That's the difference that turning it into a straddle made. So we have less risk on this position than with AMD. However, it will be harder to get out of this position than with AMD. So they're both essentially, they're going to behave in the same way, AMD and SMH. So I chose to manage them slightly differently as a little bit of a hedge diversification or whatever you want to call it. So next up, we get to the really fun stuff now, GDXJ, and this is why strangles are superior in my humble opinion. So if you look at the graph, it seems pretty straightforward, but if you look at the order chain, you'll be able to see that a lot has been going on. So originally this was a strangle at the 42 and 52 strike, so the 52 strike there and the 42 there. What happened? Price came down and tested our short side. So we rolled the call side down from 52 down to 48. Down from 52 down to 48. And then we rolled the put side up. So market came down. We rolled the call side down. Market then reversed. We got whipsawed a little bit. And we rolled the put side up from 42 to 46. Market kept moving against us higher, so then we rolled the put side higher from 46 to 48. Market kept moving against us higher. At this point, when we rolled from 46 to 48, at this point we were in a straddle because of the roll that we did on the call side. So we're in a straddle at this point. Market keeps moving higher. So then we moved the 48 put to the 50.5, and the whole time, as you can see, we're just collecting premium. We're just collecting premium. And then what we did, this is where the magic happened, right? So at this point here, the 48, when we rolled the 48 put up to the 50.5, the position was 50.5 on the put side, and then it was 48 on the call side. That was the position. It was inverted, right? And it was quite narrow. It was the width of the inverted strikes was $2.50 wide. We had collected $3.50 something at that point. So we were in a pretty good position. What we chose to do was we chose to buy back the guts and sell the wings. That's just a fancy way of saying we uninverted the strangle. We and basically put it the right way back again. So this position is no longer inverted. This is now just a normal strangle, and that's at the 54 and 47 put. 54 called the 47 put, and we've collected a total of $1.28. That's accounting for the debit that we paid to buy back the guts and sell the wings. So we've still got $1.28 in play, and we've managed to uninvert an inverted position. So the reason why strangled are so powerful is that you can manage risk so much better than with a covered position like an iron condor. The market just kept moving against us, kept moving against us. We just kept following the market with our strikes, kept following the market, kept collecting a premium. When the time was right, we switched the strikes around, uninverted the strangle, turned it into a normal strangle again, and yeah, happy days. And now we've got a theta working for us again, and now we've got another chance of having a high probability trade work out in our favor. So that's GDXJ. We've already gone over SMH. UAL. So UAL is in a very similar situation to GDXJ. The only difference is that with UAL, we haven't bought back the guts and sold the wings yet. So this is still inverted. We haven't uninverted it yet. The reason for this is because we just hadn't quite collected enough premium to be able to pay for the uninversion. It's very, very similar story to GDXJ, except with UAL, we were never whipsawed. The price just literally just went straight up from day one. So this was the original strangle, 35 and 50. As you can see here, price moved against us. We rolled the put up from 35 to 42. We rolled it up again from 42 to 48, and again from 48 to 50, again from 50 to 52.5. The market's just moving against us higher and higher this whole time, as you can see here. We're collecting more and more premium. We go from 52.5 to 57. At this point now, it's $7 inverted, so we've locked in a synthetic loss of basically $7. And then what we do here is we roll out the entire thing to the next expiration cycle, and that allowed us to collect a massive $1.80 in premium, which has boosted the overall credit on this position to a massive $7. So there is a locked-in loss of $7.50. However, we've nearly collected $7 in premium. So we're looking at a best case scenario of about a $50 loss on this position. To just put that into perspective, our original position, our call was at 50. The price right now is trading at $58 basically. So we would be if we didn't do all of this, we'd be looking at about an $800 loss right now. However, we're still in play and we're still working to get this back to a scratch. So we are looking at turning this $800 loser into potentially a break-even trade. This is the power of naked positions. Let that be a lesson to you all. That's all the positions. You do need to keep in mind the size of your positions. Don't get too big, otherwise it will cause problems. Now, the way that this position sizing template works, everybody can get this for free. The way it works is you enter in the size of your portfolio. Let's say if it's $25,000, below that you enter in what the current VIX level is. And then everything below that will be automatically calculated for you. It will tell you how much buying power to allocate to a single undefined risk position, a single defined risk position, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow this over the long term, you will be fine. To get a copy of this, click the link in the description, click on free position sizing template, and it will take you to the spreadsheet. If you want to get involved on the positions that we've got on, if you want to make plays with us and copy our positions, head over to click the link in the description, head over to EDS Premium, get yourself signed up. We have multiple portfolios, so it doesn't matter what size portfolio you have, there'll always be a position for you to copy. There is a full course, so no prior knowledge is required. We will teach you everything you need to know. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money back guarantee. So if you study our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free. The price is £1 a month right now. The price will be increasing, but once you're in, you don't need to worry about it as long as you don't quit and then rejoin at a later date. So you are rewarded for getting in early, and I'll see you guys on the inside.